There.
But don't say it.
All right. Morning, everybody. Thanks for joining. This is the latest Orlando Tech Community 10X Talks. We do these kind of the second Tuesday of every month. We have chats with founders on relevant topics, on industry panels. So I'm actually going to put a link uh, in the chat here that gives you a forum where we're trying to get feedback from attendees, trying to shape our kind of content roadmap, understand if these sessions are valuable, what you want to see more of, what you want to see less of. So if people could access that, give us some feedback at some point here, that'd be great. I'd say I think David and Ashley are on. The only things that come to mind, we do have a 10X Tech downtown on this Thursday at the social. That's just a general networking Orlando tech community get together downtown. So that I think we have a couple hundred people, 250 people registered for that. So if you want to get more involved, if you want to meet other people in the community, that's a great event to do so. And then in general, we're we're always accepting new members into Orlando Tech Community. We just started the new year. We have some more champion sponsors. We're looking for obviously anybody who wants to get involved. Please reach out to me or David or Ashley, and we can kind of help get you the lay of the land and see if it makes sense for you to join. Without anything else, I'll just shut up and then we can get into the topic of the day, which is on the state of venture capital in Florida specifically. I will, are you guys able to see my screen now? Yes. Perfect.
Yes.
All right. So it'd be great if we could just start with some intros. We'll go left to right on here. So Kathy, you can go first. Just kind of your name, your firm, where you look to invest, if you're actively investing, and then we'll go from there. Typical check size, things like that.
Okay, so hi, I'm Kathy Chiu. I am a partner at DeepWork Capital. Many of you know us. We are early stage venture capital investor focused on tech and life sciences. Typical check size varies a lot, partially because we're also the investment manager of Florida Opportunity Fund, which is the state's venture capital program. And so it ranges anywhere from, oh gosh, $500,000 to $5 million. So just depend on what the situation called for and whether or not we have a bucket where that mandate meets the company's profile.
Awesome. Dennis?
Hi, everybody. Dennis Pape. I am the managing member and CEO of Seedfunders Orlando. We are an organization that's a group of angel investors. We have sister organizations in St. Pete and Miami, and in total have about 70 members. We have about 16 here in Central Florida. We invest in pre-seed startups, startups that have a minimum viable product and customer traction. Our typical check size, we've been as small as 50K and as large as, I guess, 200K. So we each invest individually as members. We pool that money together.
Awesome.
And we're active.
Yep.
Yeah.
Sorry, Dennis, what was that?
Yeah, we're investing now. Yes, we're actively investing.
Awesome. Rob?
Good morning. I'm Rob Panepinto. I'm the managing director of GoVo Venture Partners. We also invest at the early stage. For us, seed to Series A. We have a very specific niche. We invest in companies that are in government regulated industries or selling directly to government. Our first check is generally around $500,000, but as low as 250, as much as $1 million. I also do run a small social venture fund based here in Orlando, which is kind of at the end of its runway, so is not investing more, but has made probably half a dozen investments in Central Florida social enterprises.
Awesome. And then Kyle?
Cool. Hey everybody, I'm Kyle Asman, managing partner of Backswing Ventures. I'm on my second fund. We've done 8 deals out of the second fund now, Backswing Ventures Fund 2. We're focused on dual-use technology companies with $1 million in revenue valued under 20 million, mostly investing in the seed stage or pre-Series A, Series A. Our check size anywhere from 100,000 to $1 million, and we're not geographically tied to any specific region.
Perfect. And I guess one thing we didn't hit on is I think everybody here has invested into Orlando-based companies, correct?
Yep.
We have not through GoVo, through the social venture fund, yes, but
Yes.
we've made
Yeah.
5 investments, but not one in Orlando yet for GoVo.
Yes, got it. All right, so I'm gonna go through, I think, three charts. Dennis, you were so kind as to interject and try to steal my role as the moderator here, but I included, I think, 1 or 2 of yours. But these are hot off the press. Obviously, we just pretty recently wrapped up 2023, and so this is our analysis on U.S. venture capital deal activity over the last 10, 11 years. You can see a general upward trajectory, and then 2021 kind of everybody lost their minds. And since then, deal activity has really slowed down. Deal value declined 31% year over year, the lowest since 2018. And then deal count declined 26%, the lowest since 2016. There's kind of a tale of two worlds in venture, so I did want to just call this out. The rounds that are over $100 million, which are almost detached, almost a different asset class, that's what drives a lot of the headline numbers that we see. So you can see here that there's a pretty high correlation with what's actually driving those totals, these giant mega rounds of, Adam Newman's new company raising $300 million at $1 billion valuation with just an idea. That's what was, for the course in 2021, that's come to a crawl. And then Dennis, you shared this. This is pre-seed and seed activity in Florida. You can see that it's not as volatile. There's still more of an upward trajectory to the right, but not the same kind of whiplash as we're seeing with the giant mega rounds. So, with those kind of 3 charts and data points, I'll pause there. And Dennis, since you were so kind to start sharing some information, I'll start with you. Just, what your pulse on what you're seeing in the venture market and kind of your reaction to the 2023 numbers as we wrapped up the year.
Well, I think we're seeing that with this chart is that you're absolutely right. We're not or we haven't been as dependent on the mega rounds, although, of course, we all know about crypto and blockchain that did achieve some of those mega rounds. And we ourselves here in Orlando just announced in December, I think you'll talk about this again, Core.ai just closed a $150 million mega round. But this chart is showing that at the pre-seed and seed level, which of course are not those rounds, not as volatile, it's down, but you can see the numbers, but we're still above the 2020 level.
So, yeah, Kathy, are the headline numbers, this crazy decline, is it as bad as people think it is? Is it worse? Is it not as bad? Where do you kind of shake out on how the whole venture ecosystem is feeling right now?
Yeah, I think there's 2 components, right? There's always been deals that should be funded and deals that maybe aren't quite ready or frankly is not right for venture funding. But I think during the kind of the crazy optimistic years, what you're seeing is a lot of money coming in, and most importantly, money that aren't very familiar with this space, meaning early stage, and maybe they're later stage funders thinking valuation's gone so crazy, I gotta go down, a stage just so I can make the same kind of return. And so when
You're good. Sorry.
So when that started fading away, that you'll see a decline in the total number. But the truth is, if it's almost like a flight to quality. You know, if you're a good company that has the right kind of thinking process and the kind of prospects, investors are still there. There might also have been sometimes what you're seeing is the adjustment of valuation expectation. Market goes up, market goes down. And with that, the kind of valuation multiples, and investors and entrepreneurs are both affected by that, but they may be tracking it once a forward, once a lag. And so when that happens, you'll see a lot more friction. So deals don't get done, but not because the money wasn't there or the deals aren't there. It's really just people aren't coming to the right expectation, and that takes time.
Kyle, any thoughts on what you're seeing? And
Yeah, I think that our space, the defense space, is a little more cyclical. So we see, probably a higher percentage of deals getting funded. But I think what a lot of good Kathy was saying was right. There's really been a flight to quality. I mean, I saw a lot of deals in 2021 and 22, and still now that really shouldn't get funded. And I think the market's kind of, working itself out. And there's a lot of companies that don't deserve funding that aren't getting the funding that they're seeking. And the quality companies that have a focus on revenue growth and a focus on getting to break even, those companies are still getting funded. I mean, I've heard a lot of dire things out there about the market. We've had 2 exits in the last 3 years, pretty good sized exits. And we've seen a lot of up rounds for our portfolio companies that are profitable or close to. So I don't think that, the entire market's dead. I think there's just some of the froth is getting knocked off. And I think that's a net good thing for the market.
so if what I'm hearing is right, it sounds like that both Kathy and Kyle, you're saying that it's not as much as it's not as much as we're in a bad spot in 2023. It's that 2021 was so crazy, and that it's not, maybe we've hit a new normal or stabilized. Is that
Yeah,
more?
I mean, if you do make the comparison that, all right, a lot of hotels and other businesses would make, you make the 2019 to 2023 comparison and take out the 0 interest rate, free money environment of 2021 and 22, you're down, slightly year over year, still down, and that's a shakeout of the froth, but that's a slight decline. That's not like the Great Depression of venture, which it looks like if you look at 21 numbers versus 23. When you look at it 19 to 23, it's really not so bad.
Rob, is this more or less in line with what you're seeing in the market?
But I think there's a missing leg of the stool, which I think you may have a slide in later. But first, I think you said early on there, you have to separate these markets. I mean, pre-seed, seed investing, it almost is a different asset class than the end of the venture pipe. And that end of the pipe was largely overvalued and right now is clogged, right? Because so few of these companies are going public. So it does skew the macro numbers in a way that I think we should be careful, particularly here, because most of this audience is probably at the earlier stage and the later stage. But the other leg here is, which goes to Kyle's point about quality, valuations in the early stage have not dropped. So the deals that are getting funded are still getting funded at valuations. Actually, I think they're actually, from the PitchBook data, are actually higher than they were a couple of years ago, which isn't happening in the later rounds. So I think we got to be careful. We got to look at sort of the whole picture. And so I'd agree with what Kathy and Kyle said, that at the end of the day, regardless of stage, the good companies are still getting funded. The good news for the earlier stage entrepreneurs, they're still getting funded at reasonable valuations at the earlier stage.
That's absolutely right. I mean, the valuations that we've seen knocked down are those that are closer to exits. The exits are not happening. The IPO market has been shut down. And so that's first dramatically affected the Series kind of D rounds. And in fact, when Instacart went public, a lot of the investors at the latest stages actually lost money, overvalued. So those down rounds then propagated downward, but they're holding, the valuations are holding at the pre-seed and seed level because it's so far out for exits. Who knows, what the market is going to look like. So we haven't seen that impact at this level.
Yeah, to your point, Rob, like I always say, there's there's almost 2 different asset classes. The one way that I'd say they're correlated almost is that venture often works like a conveyor belt where like if the IPO market dries up, then it impacts the growth equity market. If that dries up, it impacts the mid stage, then the early stage, then the seed stage. And so kind of moving on to this point, this is a resource through PitchBook, which I encourage people in the audience to go look at. It's just the PitchBook Deal Making Index, and you can see in 2022, which just at a high level means that there's a delay, right? Because the market started declining in 2021, so it takes a while for these terms to reverberate back to the market and for the new expectations to flow through. But you can see here, this was kind of the peak froth. This is the lowest it got, where the founders had the most leverage in the history of this resource, and it's gone from 5.6 to 85 as far as being founder friendly versus investor friendly. So they aggregate these terms and they've reported this. But if what I'm hearing is correct with what you said, Rob and Dennis, is that you don't think that the valuations and the terms and the leverage back to investors has reverberated back to where you guys are investing. Is that correct?
Well, terms and valuation are two different, right? Or two different
I would
things.
throw them all in.
Yeah. So valuation, I'd sort of stand by what I said before. On the term side, that's a little bit different. But again, I'm not sure, for at least for us, how much to equate that to a macro market, or is kind of like similar to Kyle, being in a specific niche, which may allow you to get different terms because the company might be seeking the expertise, not just the capital. So for us, we're able to get some different leverage in terms. And to be honest, I can't percentage it. How much of it is just macro market change versus I want someone who understands government space and I'm willing to give them a little bit more, maybe not in valuation, but in terms of a board seat or voting rights or other preferential or advisory shares, other things that we're still definitely seeing. And I would say, and Ken, you sort of taught me this in Florida, or educated me a little bit, particularly because we will lead rounds, and a lot of Florida funds will not lead rounds. And there's a lot of the entrepreneurs often really want to lead because there's a bunch of people who will then follow if they can get that lead. On the term side, we're actually, it is much more investor friendly, but on just the pure valuation, I do think those things are holding up. So I kind of gave you a muddled answer, but that's what we're saying.
Yeah, Ken, what we're seeing is that the valuations are holding, but I think there's confusion amongst startup founders about what their valuation is. And that is, at the pre-seed level, it's really early, it's customer traction with MVP, 0 to just very early revenue, 100K ARR, something like that. And that's really a true pre-seed, and PitchBook has got those valuations at around $6 million. The next level is a seed level. I would define that as some customer, sales. The sales motion is happening. I don't know, at least 500K ARR, and those valuations are at around $12 million. And I think we see startups coming to us at least with, $12 million valuations that are really at the pre-seed level. So I encourage founders to really understand where they are in the marketplace, to understand, what valuations that investors are putting on startups.
I think some of these investor-friendly term, and obviously without knowing the details of what got aggregated into this index, could also be the fact that because we had gone through a kind of a dip, and so what you're seeing is a lot of the later stage companies are actually now seeking bridge funding, but because it's a bridge, it's a much smaller round. And so that all impacts the kind of terms you might be able to put on it. And also, if they're in a little bit of a pickle, they're more willing to give up on some things, and sometimes, allowing you on the board or maybe some sort of very friendly convertible terms, so just get me to that boat, and if I fail to reach the destination, then yes, you get your money back. That kind of terms are not available because of that dip previously.
Yeah, I guess just without getting overly analytical on these numbers. Just is this directionally what you're seeing in the market? Do investors have more leverage? And how should founders, especially at the pre-seed seed stage, likely the people that are on the call, be thinking about this dynamic as they're raising capital? I got Kathy, I'll push that back to you, and then Kyle, would love to get your thoughts on it.
Sure. So just continuing on the, some of these may be the later stage companies, slightly later stage. I would say I have just, anecdotally have seen several deals where the, entrepreneurs wanted a certain terms, and after all is said and done, even the insiders agree that we needed to take a more investor friendly term. And I think the reason for that is just, you want to work with the market, and you right now cash is king. You want to make sure you can survive. So I think from a entrepreneurship, if I were an entrepreneur, how to think about this. Obviously, we all like better terms for ourselves, but sometimes it's more important to get to the goal line and get the deal done so that you can live to fight another day.
Yeah, I agree with what you're saying. And one thing is, depending on stage too, I think you have to separate early stage and later stage as far as being a founder and where you are. The early stage deals, a lot of investors want to get into them, especially us, right, at the seed stage. So there's probably more negotiating power for the founder earlier, actually, I would say, in that seed Series A stage than later. Because those later stage deals, because of the way the IPO market is right now, those companies don't really have any other option but to take venture financing. It's venture financing or go under. So they need the money. When you're in a seed, pre-seed growth stage, hopefully you're getting some revenue, you're getting close to profitable. Hopefully you don't need the money, you want the money for growth. And if you're a founder and you can negotiate from that position, like, look, I don't need to take anything, but this is going to help me get to where I want to go faster. That's the tact I would take if I was a founder about it. And, there's reasonable negotiations. Again, sometimes on valuation, if it's 10 or 12 million, specifically in the seed stage, I wouldn't go to the end of the earth battling over it. I would maybe get some other concession, like, you preserve a board seat or some, follow pro rata rights or some information rights or, somebody else paying for the legal fees. All those things are, definitely different considerations when you're negotiating a term sheet with a VC than just the straight up valuation.
Yeah, I guess just it sounds like, if I could boil down some of the things that you said, it's, build out your alternatives. And I think that this is a factor of a lot of founders negotiating from a position of weakness rather than strength. And there's not as much capital, right? So there's not as much competition. And then there's too many startups from the peak kind of COVID ZERP environment where they were default dead, not default alive. And so now they're out, desperate for capital, and they have no leverage in these negotiations. But it sounds like the overall consensus is, founders should be flexible on and willing to negotiate and be, intentional on building out their alternatives. Is that
just you just always want to be in a position. Like, the worst thing that happens is when you have a portfolio company in the portfolio or somebody trying to raise capital, and they're coming to you and they're like, I need money, like I'm gonna be out of, as soon as somebody starts with, oh, I'm gonna be out of business, or I don't know what I'm gonna do if I don't get this investment, that in my mind makes the company distressed at that point. And you invest in venture, at least I do, for growth. You don't do it to bail people out or for distress. You don't throw good money after bad. So again, I would make it, always take the tact of, hey, I don't need money, but this is going to help accelerate me and get to the next level, which is, at the end of the day, the purpose of venture investment.
Anybody have anything to add here? Otherwise, we can jump to some other points. Okay. Yeah, so wanted to share this. This was the top deals in Florida from the last year. No real discussion point on this other than, is there anything that we can take away from some of these opportunities that we're seeing, the deals that are getting done, some of the larger investment opportunities in the last year in the state? Going once, going twice? No.
I mean, I can say, look, as far as I follow the market, I generally look at, average valuations. And and I generally look at deal count. I don't get so wrapped up in, what the largest deals were, the total dollar value of deals, because that can be skewed by a couple of deals. And I'll go out and say all the time, a lot of my strategy is, if we invest in companies at 10, $12 million valuation, there's a lot of 60, 70, $80 million companies out there, which, if you invest in a company at 10 and in 4 or 5 years, it becomes worth 70, 80 million. That's a good return for most seed stage investors, unless you've got a crazy fund. But to me, there's just so much risk investing in a deal at, 800 million or, $250 million valuation, right? Because for that to get a return, you're talking about this becoming $1 billion company. You can go look out there at how many companies, even on public markets in the United States, are valued over $1 billion. It's not that many. So, the later stage investment, has never made a ton of sense to me personally. I'm sure there's people who make a lot of money in it really good, but, as somebody who does seed Series A stages, and that's kind of my thesis and how I look at these deals, investing in companies at a 3, 4, $800 million valuation has never really quite made a whole lot of sense to me.
Yeah, I would say the only thing I noticed when I was looking at this is geographic diversity and industry diversity throughout the state. There's obviously a lot of good companies in a lot of different areas throughout the state. It's a lot of opportunities that we're seeing, biotech, health, robotics, AR, VR, fintech, SaaS. It's not one kind of dominant industry that we're seeing.
So Ken, based on that point that was made, this was an output from deal books sorted by deal size in the state of Florida. Is there a column for that kind of return that I think Kyle just mentioned, or that's a calculated metric you kind of got to layer in on your own during due diligence or review?
Well, yeah, these aren't exits. I mean, we can try to ballpark it, but no, there's no way to just grab that now.
Work for analysts.
So kind of shifting to Florida, you can see the quarterly activity here. This has gone from over 4 billion, a couple hundred deals, down to the last few quarters. It seems like we've almost stabilized around $500 million to $1 billion, and then around 150 to 200 deals. So, Rob, I'll pass that to you. Is this, do you think this is the new normal? Do you think we're gonna kind of start
Hi,
growing
Javier.
here?
I'm sorry, Ken, I missed the last part of what you said.
Do you think we're stabilizing around this point?
Yeah, I'd assume. I'd assume so. If anything, I think some of the macro things that hold the market back seem to be waning, at least in terms of interest rates and cost of capital. Right? You'd expect that to start to drop over the next 12 to 18 months. Look, again, we play in a very specific niche at a very specific piece of this chart. So for us, we look nationally, but certainly expected to leverage our networks and connectivity to Florida. And 4 of our first 5 investments are in Florida. And I don't know that I had hoped that would be the case. I didn't know that I necessarily expected that to be the case. And I don't think it's necessarily only because we're only seeing deal flow from Florida. So I'm continue to be bullish on the state, certainly relative to the sectors that we invest with, some of which overlaps with where Kyle invests. So I would hope to actually see a bit of an uptrend here. I do think, again, the one that I will keep coming back to, though, that's a little bit of a stumbling block if you really want a growth. And again, I'll give you credit for it, Ken. I do think more funds need to lead rounds, because everyone always wants to be the second, third, fourth, fifth check, and someone's got to be the first check. So I do think, if I was thinking of an impediment here, it'd be more folks feeling more comfortable being the first folks to write an institutional check to some of these early stage companies.
Yeah, Rob, I'll piggyback on what you're saying about being the lead, because this conversation comes up all the time. Companies ask us if we'll lead around, and I said we'll be the first check. We'll set the terms. The only thing is, I have a very defined investment range of kind of 100 to $1 million. It's usually around 500K, especially if we like to follow on. So sometimes that just doesn't work, is the lead amount. Somebody wants the lead investor to be the largest check, not necessarily the first to set the terms. But in terms of that, we lead. But I always find it funny when I have a conversation with founders about leading, Because I'm like, well, what does, leading mean to you? Because it has different meanings to different people.
I agree. Although, again, that's one of those areas, to Ken's earlier point around flexibility, because again, in some of the stuff we've done, we've not been the biggest check and we've led.
Yep.
So, but I agree with you. That's the conversation with the entrepreneur up front, because sometimes just having that lead allows others to then come on board. And so they're willing to do it for less money as the overall percentage of the round, because they need the lead to get the folks on the sidelines to come in.
Well,
Exactly.
so a comment on leading. I think sometimes there's a dynamics issue. So many times you'll see a company with really deep-pocketed existing investors, and yet they're looking for a lead. And so finally someone, a little small fund might come in and quote unquote be the lead. And really what they're saying is the people who put down the terms. Because as an insider, sometimes there's you might have other co-investors who weren't going to follow along and some who are. And frankly, maybe the company needs a down round in order to get a deal around. The only way to do this is to have a third party coming in who doesn't have all the emotional baggage and friendships and around the board to do this. So leading the round is sometimes just that. And I think, for folks who think they needed to write a big check to lead a round, sometimes that's not really what the company is looking for.
Yeah, I think you're spot on. I think you're spot on, Kathy. Yeah, particularly if it's a second, if it's a second seed or an extended seed as opposed to the first check. I completely agree.
Yeah, Ken, I would comment on this slide again. We're talking about total aggregate VC activity. And if we go back to the Florida only slide on pre-seed and seed, you can see that where the trajectory from 2014 to 2020 upward trajectory, 2023 is a little higher than 2020. So I'm optimistic about 2024, that that the outliers were the 21, 22, and I'm thinking that 2024 is going to continue kind of this upward trajectory, unlike perhaps the previous chart that you showed. So we'll see.
Okay, so just to get through the rest of these, if you look at this on a annual basis, that trend's even worse. Understanding Dennis's point on the, kind of the outliers, the mega rounds that are going to drive a lot of this activity, but you can see the state as a whole decline pretty materially year over year. So I think, trying to tie together some points, if you looked at Florida annually year over year, it's the decline in value is twice as high as the United States as a whole. California was down 19%, New York 40%, Massachusetts 26%, Texas, Colorado, these are the top 6 states for venture, and Florida was year over year down 62%. And one of the, understanding Dennis's point on the trying to bifurcate these two more or less different asset classes. But one of the concerns is we're actually below where we were pre-pandemic. And so it's almost, you would think that a lot of the capital that's moved here is investing here, and that there's more institutional dedicated asset managers that are creating predictability around the asset class. But this chart would tell you otherwise. So I mean, Kathy, is that, on your point on leading rounds, the institutional investors, have we not institutionalized the asset class enough in the state to deal with these kind of wild swings that we're seeing?
Well, there's definitely still a lot of work to be done. And so that's the first reason is, we just aren't there yet. So yes, the short answer is yes. But then in terms of parsing out why we have such a dramatic drop, well, part of that is just it's just a mathematical anomaly from the successes from the previous year, right? So for a long time, 2-3 years, Florida was the place to go move to if you're a venture capitalist. And we see all these popular venture capitalists coming in, and the big names aside, there's also a bunch of other ones that kind of follow them. And the truth is, they just kind of showed up. They're here to kicking the tires and checking it out. And until they really put down roots, they're not really here to do Florida deals on a sustained basis. And so some of the previous years you see are maybe people who are kind of like part of the buzz. And, as they kind of started to settle down, you see a dramatic increase, but it's from a higher point. And to your point, yes, on an absolute level, we are, kind of dropped from the pre-pandemic situation. But I would, based on what we're seeing in terms of the activities and I would say that if you look at how many venture capitalists there are from, say, 5, 8 years ago, I would still say that there's a whole lot more of an ecosystem. There's still work to be done, but it's still an upward swing, which is in the little, downward of the zig and the zag. But I think we're okay.
Yeah.
And I would, go ahead, Kyle.
No, I don't think the number's as bad as it looks, right? Again, I don't like deal value because you can have a couple of deals that skew that number. So taking out that number, the count from 22 to 23 is kind of in line with the decline you see in other states. And, you look at it like I moved to Florida in 2020. A lot of VCs moved here probably over the last 4 years. But if you look at where things were in 2019 versus where things were in 23, I mean, you're talking about a difference of 33 deals getting funded out of 800. So, I mean, it was down. And again, I don't think anybody's arguing that there's decline, but I'm just saying, for anybody out there as a founder of fund, I wouldn't be totally discouraged because I don't think it's as bad as you can get some numbers to reflect.
I wonder if you stripped out, I don't know where a Magic Leap sits in one of those years. I don't know where a lot of buzz around Miami crypto fits in those years. I wonder if you took some of that out, how that normalizes over those couple of years, because we're starting from a smaller base, right? So to everyone's point, a bigger number is the loss of that bigger deal is just going to hurt us. And there's no doubt there's a lot, right? There was a whole bunch of crypto stuff being funded in those years that just isn't being funded right now.
Yeah, and Ken, I would comment on this again, looking at the kind of the internal dynamics. You'll see, every state is, every state is different, right? So the makeup of kind of the pre-seed seed funding percentages versus the total VC market in each of those states is kind of dramatically different. We've got a significantly higher pre-seed seed component than some of those states. The question of market sector, deep tech versus B2C can be very different. So if you dig into those numbers, I mean, the aggregate it is what it is. You're showing it, but it's very different when you look at the different market segments and the different stages.
Yeah. I guess just, the numbers are numbers. But if we can zoom out and take the kind of pulse of what might be, driving some of the activity, that's where I'll kind of drill into now, which is, I've made the point that there's a lot of, we were just talking about institutional investors leading rounds, things like that. I've made the point in Florida, there's a lot of over reliance on angel activity and things like that are in the state. Dennis, you have a pulse on, the angel investor community a little bit more, not just in Orlando, but in other markets. And, I've made the point that when times are good, they're great for angel communities because everybody looks at their 401ks and stock holdings and says, great, I can put money in startups. And when times are bad, they pull back from the market, and that can lead to these wild swings. So are you seeing more of a pullback? It sounds like both Kyle, Rob, Kathy, everybody said, we're actively deploying. Have you seen angel investors as individuals pull back in worse times?
Most definitely. So for Seedfunders, 2023 was not a robust year for us. And when you think about it, funds are committed capital dollars raised and closed. So you guys are deploying based on money in the bank. We're as angel investors are cutting checks. So the interest rates, the availability of other investment opportunities for angel investors. There's no mandate. There's no to invest. There's no sense of urgency, I don't think, from angel investors. So cutting checks when the economy is when there are alternatives is problematic for investing in early stage and pre-seed stage companies. And so we've definitely seen that pullback. It affects us much more dramatically than a fund.
Okay. Dennis, I know that you had shared this, and just talking through some of the bigger markets. I got a fire alarm going off in my hotel. So Dennis, I'll let you take it from here.
Well, I was looking internally at the data on market, pullback and saw that Orlando is significantly greater decline than either Miami or Tampa Bay. And, again, looking at the internals, different markets with different, market segments and different stages of funding. I see Orlando as very, I would say, a little more lumpy, and that we've had some very big deals, particularly in cybersecurity, as many of you know, ThreatLocker and others, and those have contributed dramatically to our rise. And when those go away, which they did in 2023, we see some dramatic falls. I think Miami and Tampa Bay are a little more dispersed in terms of the kinds of deals and the value of the deals, and so the decline hasn't been as great. It tells me that that our ecosystem needs to, just continue to foster, scaling companies and a diverse group of scaling companies that is capable of raising capital.
Okay, I'm gonna move to these last kind of discussion topics. So just maybe around the horn, it sounds like everybody's actively investing. If so, what are you looking for? And maybe tying this together with this next question is, what advice would you have for founders getting in front of you? What's exciting you in these opportunities? So what are you looking for? What's exciting you? What suggestions would you have to founders? So Kathy, I'll start with you.
Sure. Yes, we are actively investing. And like I mentioned earlier, we focus on both tech and life sciences. And in fact, if you're one of those fundamental science companies, we may be the kind of the only kind of investors in town at this stage. But what I am looking for, I will say the funny thing is, what's exciting isn't so much kind of like a big dream that's like, crazy ideas. It really is about a very clear value proposition. Be very clear about what problem you're solving, what value you're providing to what market. And when I start that conversation that way, I have a very clean idea of what you're all about. And that allows me to get excited to spend all these extraordinary amount of energy to dig into, the details.
Rob?
We're definitely actively in investing, and as I said earlier, we're looking for companies that are in either in government regulated industries, tackling government regulations, or selling to government. Interestingly, one of the things that we've seen, which does excite us, is one of the other positives of the migration of people to Florida are founders. We've seen several of our investments are folks that are experienced entrepreneurs who have had other businesses, who have moved here to tackle a similar problem or a different problem, and that's been really attractive to us, particularly at seed stage, right, where we're probably first check in. If you can get an experienced entrepreneur who's got 1 or 2 wins under their belt, that's obviously exciting for us to see. But I have been surprised by the talent that's coming down, I guess, from a lifestyle and all the reasons people come to Florida. But that's been a pretty interesting observation for us. I just to add on too about Orlando, I would really like to invest more in Orlando-based companies. And I will say there are a couple in our pipeline. One of the companies we're probably about to invest in is technically not based here, but has some of their operations here. But I will say we are seeing more things outside of Orlando. And in our niche, I expected to see more in Orlando. So I don't have an answer. I don't have an answer for that. It may be what Dennis said earlier, that we're just continuing to build our ecosystem. But man, I actually would like to be excited about some more folks that I could find in our hometown here to invest in, to be honest.
Dennis, anything that you're looking for and that's exciting you right now in the market?
So as I said, we're looking for those companies that have a, minimum viable product and have some customer traction. Lots of excitement. I mean, we span Orlando, Gainesville, Space Coast. So we're seeing a lot of interesting companies, no shortage. I mean, even though with those charts, everything going down, number of founders, number of new companies is steady, if not increasing. Lots of new ideas, particularly in AI, and applying AI to various market sectors. So what we see at the front end, though, and I would recommendation to founders is that the best companies that we see in terms of where the fundraising process, and I recommend this to any company, is to just start talking to folks. Talk to Ken at DeepWork, talk to Rob, talk to Kyle, talk to everybody. Kind of get the lay of the land, particularly the lingo, what valuations look like, what terms look like. And they're very, and most, as we can see, they're very Florida centric. I see a lot of entrepreneurs that maybe pick up data, the first time entrepreneurs have never raised capital. Their knowledge base primarily is from doing some internet searching, and maybe it's from California or Texas or somewhere else. And so I highly recommend know where you are in the space to optimize your probability of raising capital.
Yeah, and then Kyle, anything you want to add?
No, again, like I said, the big focus I've had on both funds is revenue and profitability. I got a lot of weird looks in 2020 and 21 when I started the first fund and started asking people about when they were going to be profitable. But I think the ability for companies to sustain on themselves and use their own cash flows to grow and not be dependent on the capital markets, is the most attractive thing we can see in companies. Again, we're very sector specific in that dual use technology, but the biggest advice I could give to founders is, hey, make yourself not seem, even though you might need the money, don't make it seem as though you need the money, and focus on getting to a point where you're not dependent on capital markets.
Yeah, in general, I mean, there's less capital in, so everybody's one way or another a little more risk off. And like Dennis said, some of that advice is around, the relationships, and there's a risk there, and mitigating the relationship risk. There's an issue of mitigating some of the the revenue and traction risk and execution risk, which I think Kathy and Rob mentioned. So if you can find ways to mitigate risk in every aspect, whether that's customers, traction, relationships with the investors, etc., then I think that goes a long way in this market. But tactically, what else has changed since 2021, 2022? Rob, are you suggesting companies have different expectations, or are you looking at different structures, safe notes, convertible notes, equity rounds, longer runway, those kind of things?
Now, one of the things, again, for us, the fund's only been operating for 14 months, so we don't have legacy folks. But one of the things that I think we are looking at, and we'll have to see where the market turns on here. Although valuations in the pre-seed and seed stage have held up, then they start to drop off right after that. And so if you look at the time between rounds, say the Series A, and the valuation between those two, those rounds have taken longer to get there, and the valuations are lower, which I don't know that the founders are necessarily expecting. I don't know that the investors have fully wrapped their arms around that. So I think one of the things we're having some conversations with all of our entrepreneurs is, this interesting balance. I completely agree with Kyle. Like the best capital to raise is the capital running from your business, not external capital, because it comes with challenges and dilution. But you have to be a little careful in that first stage to make sure you're getting the capital you need to give you some runway, or you're probably going to see more of these extended seed, second seed rounds before you get to Series A, until that next part of the marketplace clears up. I mean, Ken, you and I were at a board meeting and a co-investment yesterday, right? And that was the conversation, because the Series A might not be as attractive as the entrepreneur would like it to think, or it's going to be harder to get. So, you know, you do, unfortunately, when you're closing the first round, do need to at least be thinking about what the second round could look like in a whole host of ways. And the only final thing I'd add to that, then, which goes back to advice for founders, is in your pitches, like, you got to know your numbers, right? You've got to be able to articulate a financial plan that at least shows the grand vision of the company, and then what the next couple of years can look like, because you're going to have to execute against that to sort of get this next round. And again, that next round is going to be a little murkier, I think, than this first round.
Kyle or Dennis, anything to add on that, on kind of tactical advice around runway, burn rate, exit expectations, things like that?
No, I mean, I think, like I said, keeping the lowest possible burn rate while sustaining growth is good. I mean, you got to make your capital last. You got to do more with less, especially in a tough market. That goes for funds too, right? I mean, you're going to be really, really selective with deals because it's not as easy to raise. So you're not going to maybe put capital into a deal that would be a fringe deal for you. You're going to be a little bit more conservative. But I think things will find the equilibrium. And I think as interest rates come down and exits pick up, I think the cycle will get back on track in the next 12, 18 months.
Yeah, Ken, I would say you showed the data from PitchBook on investor-friendly terms, and you mentioned safes. I'd like to comment there that SAFE, as everyone knows, is very founder-friendly investment vehicle. It has not been as popular in the Southeast as it has been elsewhere, and I see that trend will, maybe even accelerate, and then it becomes even less popular here. So just for founders, be aware of that.
Awesome. All right. I know we're coming up on time. So any last things to add? Rob, Dennis, Kyle, I think Kathy had to drop.
Well, that's it for me. Thanks everybody for listening. If you have any questions, feel free to reach out to me. My email's right on our website.
Awesome. Thanks, Kyle. Thank you, Dennis. Thank you, Rob. Just a reminder, Thursday night we have that 10X downtown. And then if you can provide some feedback through that link, that would also be super helpful. And then Chuck, I got your note. I'll follow up with you there. All right. Thanks, everyone.
Great.
Bye.
Thanks, everybody.